Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, March 9th, 2020. All right, let's take a look at what happened today, how we closed the day. Not too much to update since the midday video, and hopefully I always say it. I don't promise to keep this one short, but it should be shorter than the earlier video today. All right, what we did do, and this is right after the markets close. Futures keep trading, but they're really about where we closed the 4 p.m. regular session, and you can see that we had. Remember earlier in the day we had recovered. We were back testing the trend line, or right about on it, and we're back down below both the 80.78-ish level as well as that 79.98. That's that lower line right there. So look, I'm going to say this close enough that we're effectively on that support. You can split hairs, say we're a little bit below it, but remember, volatility like this, you're going to move up and down through levels. And although I hate to say this, and I do say it often, it's anybody's game. If we had closed right here, I'd say, look, that's it. That's clearly bearish. We're probably heading lower tomorrow, maybe a back test. Now, because we're still on support, there's a possibility they can rally it up, and those 60-minute divergences are still intact. I'll get to those in a second. Now, I'll share my thoughts as I always do. Nothing's changed. We had a big recovery rally in the futures. I think at one point in QQQ, I think we were up as much as almost 5%. Was it full 5% off the lows? Again, and you have to put all that into perspective. As powerful as that feels if you're long, the 4.7%, and as painful when you're short, especially if you're over leveraged. That's the thing, guys. I always say this. The way, and I'm just sharing tips and tricks that I've learned over the years. Many of those were very expensive lessons. Let me plug in my keyboard charger. Hold on one sec. But one of the things I'll pass along from experience I've learned is, one of the keys to successfully navigating a market like this, let's say whether you're bullish in a bullish trend, it's usually a little different in corrections, because in corrections, that's when volatility spikes. You don't get these 5% day after day, 3, 4, 5% plus intraday swings during a bull market. Those usually come during correction mode. So therefore, let's say you get the call right. You've been bearish, but you're just getting shaken out because market rallied almost 5% today. You're watching huge profits evaporate. So what I'm getting at, the key that I've learned is, especially if you're subject to those emotions, if you're not that strong in your convictions, or for whatever reason, especially if it's clouding your judgment or making you hit that panic button, then the key is take the position down smaller. Because when the market drops, look, we've dropped in just a few weeks here, we've dropped about 20%, almost 20% right there, 19% in the Qs, and about the same in SPY. And that's just a few weeks. So you don't have to have a lot of money in a bull market. Let's say you put in $10,000 and you want, it takes months, sometimes years to make 20%. Here you made it in just a few weeks. So you don't need as much. You could trade with, if that's your number, again, $5,000, in a position. And okay, you put half of what you usually do, but you made 20% in just a few weeks. So that's, on average, that's netted out to about a 10% return, right? If you cut your position size in half, but then you make 20%, you'd be making 10% on what you normally trade anyways. And it might help you, stick with that trade and not second guess every little move against your position. So, there are no guarantees to any of this. I'll tell you where I think. I still think there's more downside. But right now, like I said, I showed you the NQ chart. We're just below there. We closed below support here, so I'm going to take it on face value, even though it's comfortably below right now. This is the candlestick. This is the daily close on QQQ, down 7%. So we got back down to where where the halt was earlier today, and we'll see what happens in the overnight session. But let me just look at this chart from with unbiased eyes. Here's that level that we were targeting before. T1 was set on this line. Well, I revised it today to just kind of see if we can get a runner trade. And I already went over that. You guys want to, you want to use a tighter stop to protect more of the profits on this. We're about, what did I say, about 8% or so, maybe 9% now where we are at this point from where we shorted QQQ just, less than a week ago. That's up to you. But be because of, I'm just going to go over the salient points here. We gapped down today, just to kind of reiterate. We gapped down in one fell swoop, took out the 200 SMA and EMA, both of those. We bounced up, back tested, got a little bit above the 200 SMA, about halfway up to the 200 EMA, and then reversed. You can see that's a big, this is today's high right here. We gapped down. Futures were lock limit down all night. They opened up. Market rallied early on. Well, we hit a trading halt early on when the trading halt opened up. Then we rallied up and then boom, back down. So that's bearish action. It pretty much wiped out all those intraday reversals. So those were, let's say that those people buying today were both shorts covering and or maybe bargain hunters stepping in. So the longs that stepped in have now been pretty much all smoked. They had all their gains faded, so they've got to be a little worried here. And if you had a lot of that with short covering today, then that's cleared out some short interest, which if you are a bear, if you are short, that's a good thing. You want to be the sole bear, or you don't want a lot of company. Bears are not pack animals like wolves or dogs. They're solitary creatures, and that's what you want to be. Because if everybody else is short, guess what? You get a big drop like this, and everybody covers. And when you cover a short position, you're buying whatever you're short. That's how you close it. You buy to cover, and buying creates more buying. Or causes prices to go up. So stocks tend to fall faster and farther in the market when there's a low short interest. So we'll see tomorrow. Here's the bottom line. I can sit here and talk about all that all day long. We closed below support on QQQ, and that support line again is not 195.35 was the adjusted target. It's about 194.90, give or take. And below those MAs, that's bearish. And we did have to, I had several inquiries about it. Although I said I think it's a little bit too large to be a textbook bear flag. I'm talking about this here. My response, and I was asked that question several times. It's pretty much the same net effect. By that I mean you had an impulsive move down, then you had a clear uptrend line. It's not shown here. That's not the same uptrend line. It was the one I was showing you on the 60-minute chart. And so you had an area of consolidation, and then it broke, and that was your sell signal right there the other day when we broke that 60-minute trend line. And so where it could have proved to be a whipsaw, it was confirmed the next day, and it was confirmed again today. So let's keep it simple. The market can do whatever it wants. Government can come in with whatever measures they might overnight. Sure, global central banks, I'm sure all the leaders are talking, trying to get together a coordinated thing. I know they're worried. They have to be. The Fed is, almost out of bullets. There's something I want to show you there as well. But let's just take it on face value today. Another down day, and just to kind of back up to that, whether I want to call it a textbook bear flag or not, like I said, it's a period of consolidation. Here's your initial leg down, and if it is a bear flag, then you would expect more downside, something maybe comparable to that, and that could take you down here. Let me turn all the lines back on again. As I said, when I extended the targets here, it's really an open-ended trade. I don't do that often. We had going into the trade, as always, we had clearly defined trade parameters: a suggested stop, an entry level, or around there, and a price target, sold price target at the time. And I started mentioning the other day that I may extend the targets or add additional targets. So, like I said, there's the potential for more, and this would be the next target. If you can see here, logically, we have a pretty well-defined support right here, which has just ever so slightly been taken out today. It'll look a lot better if we gap down tomorrow, especially if we close the day down here somewhere. Then you'll have that former support, now resistance level, clearly in the rear view mirror, and that opens the door for a move down to that 182.20. One level, and if that gets taken out, then you have this support zone here from about 169 up to about 173, and we'll just have to see where we go from there. So we'll see. Keep it light. I don't trade around fear that Trump is going to tweet out something, or the White House is going to come out, or Powell's going to try another, some more aggressive measures to stem the selling. If you do that, then you never place a trade. Not paralysis by analysis, but fear for what may happen, way not. I'm just going with the charts right now, and just wanted to reiterate that I'm keeping this short trade active right now, and staying short for the time being. SPY is held on. It tagged that 273.50-ish level there earlier today. Remember that? I covered that in the earlier video. So we're still above support there. That's why I said it's still anybody's game. You have QQQ just slightly below a very well-defined support level. SPY just above support. So when you average them both, you just say, and plus you give it the benefit of the doubt, the last of the two to break. So you say therefore, market's pretty much closed at support today. But down big. So just because we're at support, it certainly means we can bounce. That's if you're going to bounce, it's a logical place to do so. We just don't have any buy signals. And in a bear market, that's kind of the nature of this trend so far. When support levels where the buyers, quote unquote, should be stepping in and they don't show up, that tells you what kind of market you're in. So we'll see. And if that gets taken out, there's your next stop there, probably 258.55. If today's lows on both SPY and QQQ go with conviction at any point this week, including tomorrow. Maybe we bounce tomorrow, maybe not. The more we bounce from here, then what that can do, it has the potential to put these divergences, confirm these divergences. Remember, I pointed them out earlier. They are only what I call potential divergences. They're not confirmed. We don't have a bullish crossover on the 60-minute PPO yet on SPY right here. And if we go much lower, the PPO line is going to move down through there and take out this previous low, negating the divergence, at least there on the PPO. QQQ, same story right there. There's your potential divergence, not yet confirmed. We're taking another thrust down. And we'll see what happens there. We'll keep an eye on that. And then futures, I showed you NQ where it was. Oh, that was the daily chart, by the way, guys, that I started out with these levels here at the beginning of the video. This is your 60-minute chart. So there was our little intraday rally, faded back down to about where we were at the lows. Still potential divergence in place, but it's not yet playing out. It started to play out, but we went back down. So there's something to watch here, and same thing on ES. ES 60-minute chart. Note that's a daily. I just want to show you for your ES traders, 27.35 is the same as that level on SPY I just showed you. Remember, I had these two reaction lows from back here in 2019, and a couple more along the way there. And so that's ES kind of clinging to support. But we went right on through there. In fact, remember, if you guys remember just recently, I said that, last week that if we started to move down close to the lows there on here, let me go to a 60-minute chart, close to the lows from Friday the 28th, that we would probably just, selling would probably start to accelerate and we'd go on down through there. So that's what happened. You can see here, that was low. We were rallying. Everything was good. We broke trend line. That was your first heads up right there. We started moving lower. Had a little kickback rally on that last support there. I had a 29.01. Zoom in a little tighter. And as you can see here, once we started getting anywhere close to those lows, that is what happened. That's what I laid out about a week or so ago, that we could just see a very fast move on down. In other words, we got to them. I pointed out we could test them, and we did. We had a little reaction there, but for the most part, boom, right on down through that. I'm talking that major reaction low from the 28th. So what am I saying so far? Nothing but bearish action. Potential divergences, but divergences are not buy signals. They're merely an indication you may get a trend reversal. And but the primary trend right now is pretty clearly bearish. Again, it doesn't take an expert technician, market analyst to tell you that the near-term trend is bearish right now. Crude oil, I've had a couple questions about that. I made some replies on the front page today in the comment sections. I looked back. This is not a long-term chart. This is my 60-minute chart. I'm on another monitor. I'm looking at a long-term chart. I have some resistance. It's really just a major reaction low from early 2016 around the 26, 27 level. That was about the lows today. We bottomed around 27 in CL. We had a reaction, but we bounced. But basically, we're in technical no man's land. I do not have a strong opinion. There's really not a lot of support. There's such a big gap overhead, so you really don't have any resistance overhead. And you can look at these previous highs here. This is a 60-minute chart. I don't want to spend a lot of time there. And down below, it's not solid support around 27. It's just a big reaction low from 2016. So crude's kind of in no man's land. That's what I call it, technical no man's land between support and resistance. So I'm not going to spend a lot of time on it. But as I said earlier, and last night that this is not a good thing. There's crude futures down 25%. Here's what it looks like on USO. And it's just not good for the stock market. It's not good for the financial system. Like I said, there's a lot of institutions that hold these. The energy sector. I mean, this is just crude oil. So let's say, oh, Randy, I don't trade commodities. What big deal is that? Well, energy sector. It's not nearly as large as it used to be, but there's a lot of money in the energy sector and the energy stocks because that's where dividend yields are attractive. People have been chasing yields, and therefore a lot of institutional investors, pension funds, hedge funds. 401k, the retirement plans, mutual funds that hold those things, those energy stocks get clobbered. That's a 51% drop in just 2 months there that I'm measuring on crude oil. It's just not good for the markets. Again, it ties into everything I've done today, and this is why I talk through these videos. That short on corporate bonds, somebody said, well, I don't want to do it. The Fed might come in and cut. And yes, so my answer to that person on that LQD, don't do it. If you're not comfortable, you don't have the same outlook as me, absolutely don't take a trade you're not comfortable with and that you don't agree on. Crude could turn around and rally. The market could rally. Crude just trying to hold on to maybe a potential divergent low right here. At this point, that was a triangle. We broke that triangle. There was your sell signal. There was a downtrend line, a little pop above. Broke that uptrend line, bottom of the triangle, back tested, and boom. And we're way down below that multi-year support range. Just a very ugly technical posture. Again, that doesn't mean it can't go up. And at some point, it probably will go up, and no doubt. I mean, crude's not going away. It's a commodity, so it doesn't go to zero. There's always going to be some use. We haven't switched to complete, everybody's not driving a Tesla or a Prius or whatever. So there's still going to be a demand. It just drops off during, if the economy turns down, the global demand for oil obviously goes down with it. But all right, I probably spent more time on it than I should have. If you get a rally in crude, a lot of investors are going to be looking for move back to the bottom of this 2016 to 2018-ish trading range, and of course the big old gap from today. Those are probably your big numbers to watch. So better fish to fry elsewhere. And again, that kind of spills over because the energy sector, a lot of those companies, a big part of the junk bond market. When I say junk bonds, if you're not familiar, it doesn't mean garbage, throw them away. It just means below investment grade, triple B or lower rated. And this is investment grade here. And like I talked about, a lot of these bonds, should the economy continue to head lower, should the stock market go lower, should the economy go lower, it's almost a certainty you will see downgrades, a good number of downgrades in the corporate bond market. So those that are, and there's a lot of them on that triple B, walking the line between junk status and investment grade, like I talked about earlier, those get downgraded. Plus it aligns with the technicals. So we may go, the markets could bounce tomorrow. LQD could bounce tomorrow. Like I said, it's kind of I took a little shot on this one in anticipation because it's right about on the trend line, the uptrend line there. So, TA 101 says wait for a breakdown. The reason I did it is with the way the markets are trading, the gap down today, big, huge gap. Lock limit down last night, open today, traded for a bit, then hit the the circuit breakers for the first time since the financial crisis. And so what could happen, we could gap down tomorrow, easily gap down to that first, what was that first? No, that's not the first target. That's the first support. I'm showing you a different board. We got support here about 128.36. And so I'd rather get in front of this one, even if it's going to bounce. I think we'll stay below the stop. This looks like a pretty nice topping candle, that doji right there, followed by the gap down. So that was just my take. I'd rather get in front of this one than wait till tomorrow for additional confirmation, but then risk this thing being down another 2% at support because I wouldn't want to short it there, if it gaps down to support. So, and that's the way I think the market's going. Oh, and here's the other thing I didn't say on this earlier when I posted this or in the other video. I think, I may be wrong. I'm wrong a lot. That's the one thing I'll guarantee on this site. I'm going to be wrong a lot. So don't put all your money into everything I say. Listen to other people, do your own thing, and supplement what your own analysis with some of the ideas that I might give you here. Same with the trade ideas. This is not a follow me site or all inclusive. This is how your portfolio should be. These are just throw out little trade ideas here and there. Supplement your own investing and trading. All right. With that being said, what I didn't say earlier is that I think we're in a win-win situation with LQD. It's rallied up so much. Um, and now, if the stock market rallies, then you should see money come out of investment grade bonds, particularly treasuries. This treasuries have gone parabolic because of the drop in the stock market. That's the key to the king of flight to safety assets right here. Gold is a distant second. It is second, but distant behind TLT, treasury bonds. That's where that's where the smart money runs and hides during market turmoil. Somebody asked about a short on there. The upside now in TLT is getting very limited. The 10-year was at 0.4%. We're down, I think, 0.4% yield on the 10-year. This is the 30-year. I don't know exactly where the yield is, but they're getting close to zero. There's no absolute floor at zero, but pretty much. We're not going to go zero. Go negative rates in the U.S. There's only so much downside below zero that investors are willing to take. So let's just call zero the floor. So what that means is rates can't keep going down much more in treasuries. So to go long here, in my opinion, is it's just not attractive. Risk reward is more favorable to the downside, and I talked a little bit about this in one of my replies to somebody who talked about shorting treasuries. I said wait till the market starts pricing in the impact that the dollar has finally topped. I've been looking for and highlighting what would give us a major top in the dollar for over a year now, and I think that looks to be solidly in place. So, foreign and even domestic investors, if you're putting money in treasury bonds, you have to say you put $1 million in treasury bonds, but the U.S. dollar starts dropping in value, you're losing money there. So you're hiding out safety, but you're losing against other currencies. So there's what I'm trying to say is I don't see a reason or an objective sell signal now, but if I had to be one of the two, I'd be short treasury bonds for the next, I don't know, let's say foreseeable future. But back to LQD, where I was going with that is, okay, so that was a flight to safety rally in bonds. We also had the same thing recently in LQD because these are investment grade. But what happened today? This is it. This may be the dam broke. This move down, instead of getting this huge up like we had today in TLT, these went down for the reasons I believe that I told you. Now it's an issue of credit quality. Up until now, and what usually happens at most points in time, both treasuries and LQD, investment grade corporate bonds, trade primarily on interest rates when rates and economic growth expectations, which kind of go hand in hand. Economic growth expectations are bullish, and the majority of people think the stock market or the economy is going to continue to go up. Rates tend to go up during times where all of a sudden the economic outlook declines, especially if the odds of a recession start to spike. Rates go down. Well, number one, the Fed's going to cut rates to spur growth. Number two, demand drops when demand for interest rates drop. So what you have here is, let's say the market does rally, then you'll probably see this flight to safety bid in treasuries come up, market rallies, and then rates will go up. It would lessen the chance for the next rate cut, right? Powell's not going to keep cutting if all of a sudden the market recovers and starts heading up. He's already used he pulled out the bazooka, and with that 50 basis point rate cut, he's got a little more downside, but not a lot. So my point is, I think it's win-win. Market stabilizes and rallies from here. You're going to see corporate bonds drop for that reason. A market continues to deteriorate and go down, then for the reason that I cited earlier, with downgrades that take a lot of these bonds that are being held in LQD, they take them down to junk status. LQD then must get rid of those bonds because, by prospectus, this is an ETF that holds investment grade corporate bonds. So they go to sell at the same time. PIMCO and Schwab and every other corporate investment grade bond fund out there is selling because they're not supposed to own junk bonds. Everybody's selling the same thing at once. Bad things happen. So anyways, that's my take. Right or wrong. If I'm wrong, like anything, we get stopped out, I'll move on to the next one, and I'll keep an eye on this, and if it takes whether it takes 6 days or 6 years to come back to it as a trade idea. I've never shorted LQD, never added as an investment idea on the site, a short trade idea. I've highlighted before long trading opportunities, but not short side. So this is kind of a first. All right, enough on that. I already talked about that. You pay the dividend, but the dividend's nothing. The dividend's 2 point something percent per year, which that's per year if you held it. And if we can get 6% in a few weeks, that dwarfs any dividend that's going to come out next month or this month. And finally, something I haven't touched on in a while, but I've covered this chart for many, many times. We're looking at the euro-US dollar pair, so the forex pair of the euro against the dollar. I like to use this as one of my proxies. You can chart the dollar index directly. We'll look at that. We'll look at UUP, the dollar ETF, but the euro is by far the largest component of the dollar index. Going from memory, I think it's 60, oh gosh, I used to know that number offhand. So 56 something, 56.7%, I think. And then the yen is second, but a distant second. And then everything else doesn't even matter. You can add in, just about all the other currencies. They don't move the needle. So, so if you want to know where the dollar is going, you just have to look where the euro is going and vice versa because they trade inverse. So, and the chart is very clear on the euro-US dollar pair. And I like this one because when you use freestockcharts.com or TC2000, which I'm using here, they're showing this round-the-clock trades. 3 in the morning you can get on and see what this pair is doing. And so here's the big picture. The euro has been in a downtrend. Falling against the dollar, meaning the dollar's been an uptrend. Here's your primary trend line here. It's not in jeopardy of being taken out right now, but we had a breakout of this minor price channel right here, bullish divergent low. This is a weekly chart I'm on. Same one I highlighted back here. You can see all the trend line breaks. This pair trades well to the technicals. There was divergent low, positive divergence, broke out. That was a big rally back then. Dollar sank as the euro climbed. Again, I pointed out at the time in advance and then after, during the breakout, and that set the tone for this current downtrend. So it's wash, rinse, repeat stuff. Get it? Divergent downtrend ended with the divergent low, started a rally in the euro, which was a drop in the dollar. That ended in a divergent high and rallied into resistance, fell down, and this next cycle is upon us. Same thing, positive divergence right there, and a solid breakout, an impulsive breakout right here. That's the weekly chart. Here's what it looks like on the daily chart. A little bit busier, but there was a downtrend line there. And I had highlighted euro back here as a long. Fortunately for me, I had E7. I took it out way too soon. I wish I would have just tucked it away. The move has been explosive. Wish I could tell you I would have, in hindsight, I would have trailed stops up, and that would have been a monster trade there on the E7 euro futures, and still going. But bottom line is what I'm trying to say. It's a breakout, and that's an impulsive breakout. It doesn't appear to be a whipsaw signal. It's pretty too far gone to be a whipsaw signal. And you can use, no matter what charting platform you use, UUP, this is the dollar. Here, this is the best chart to use. This is it, the dollar ETF right here, tracks the dollar. I'll use this board we had here. So this is it. Here's your major trends in the dollar. And again, why am I talking about the dollar? Well, it all kind of comes into play with what I said about treasuries. Wash, rinse, repeat stuff. Positive divergence, divergent low. There we got a trend line right there. Wedge breakout. Boom, uptrend. Big divergent high. There's your trend line. Negative divergence spanning a couple years. And boom, major top in the dollar. Correction. That correction ended with, you got it, divergent low, positive divergence. And you had a trend line right there, breakout, and the next uptrend. But we've had multiple failures right here, and I pointed that out recently too. The dollar was up here around that top of this long-term resistance zone. You can see it here. There we go, UUP. So there's just a major. That's really where the dollar's topped out for years now. This is the last financial crisis back here, guys. There's 2008, that top right there. And there's the dollar again, there it is. And again, it's just like the stock market. It's kind of priced into the charts that a major drop is coming. And this is, you had a breakdown here, and you had a kickback rally to right here, and then boom. We're right there now in UUP. That's the long tail on that stick. And this is a weekly stick. So that looks like a solid breakdown. And to me, although anything's possible, it looks like the start of a new downtrend based on everything that I just showed you here and how things looked before. So falling dollar, that should be, ideally, that should be bullish for gold, a net negative for treasury bonds, and also a net negative for the stock market. Stock market dollar's been strong because our stock market was the strongest in the world. We also had more favorable rates because we were so strong that Powell had a little room back in 2018 when he last year he started hiking rates up a little bit. So the dollar was strong because our rates were higher relative to other countries, and again our economy was strong in our stock market. Now what this is saying is our outlook has changed, and this is just like I said, it's bearish for the dollar. It's also to me bearish for the stock market. Like I said, I hope at some level, I really hope that we don't have the next big bear market. I hope this correction ends soon for everybody out there, with 401ks, jobs, especially those close to retirement. But I'm going to trade the charts as they come, and if the next bear market is upon us, I mean, we only have another 1% downside to technically hit that 20% drop, then great. I'll trade it as it comes. And if we stabilize here soon, and all the buzz over the coronavirus starts to subside, and the markets rally, and it looks like we might head up to new highs. Hopefully, I'll recognize those developments as soon as possible, and get back in long for the next ride up. But as of now, staying short, and showed you some other things in addition to the stock market that we could be trading now. And as far as 401k long-term funds, keep an eye if if you have money, a lot of money in bond funds right now. Know what your bond funds are. Most 401k, well, they'll all tell you. You have to just dig a little deep to see what they are. But most of the bond funds within 401ks are investment grades. Some are Treasury only, and the majority are going to be investment grade. Sometimes all corporate. Some will hold even a little bit of junk bond, but usually not a lot. Usually 401ks aren't going to allow a large exposure in there. So, and if you're wondering, gosh, Randy, what to do? You're telling me bonds don't look so hot and stocks don't look so hot. Historically, stocks go up, bonds go down. The old asset allocation rule from forever and a day. I was financial advisor, stockbroker back in the mid '90s when I started my original career there, and the old rule of thumb was, here's your asset allocation model, and you take your age, or the number 100 minus your age. So if you are 30 years old, that gives you the number that you should have into equities. And so a 30-year-old, for example, and again, rough rule, would have 70% of their pie. That's horrible drawing here. Sorry, I'm using a line tool. Down here in stocks, and 30% in bonds. And then the thing is, the older you get, and when you're 50-50 mix, you're getting closer to retirement. When you're 70, you're in or close to retirement, so you should only have 30% of your money in stocks, 60 or 70 in bonds. So now this creates a problem right now, and I've seen this problem coming for a long way. The outlook on Treasury bonds is god awful, in my opinion. I'll just say it. Long term rates are near zero. I just told you this. The LQD, the corporate bond, investment grade corporate bond ETFs, paying paltry 2 point something percent. And the thing is, there's hardly any upside on that in rates. The only way that yield goes higher is if the price sinks. So you're going to lose money. In other words, there's very little capital appreciation left, and you're not getting paid squat on. So there's the bottom line is there's minimal upside in bonds. I'm not saying no upside at all, and a lot of downside potential, unfortunately, more so than the upside potential. And of course, the outlook for the stock market, 11 years into the world's longest, expansion in history, longest bull market, doesn't look good either. So what do you do? Well, I'm going to continue to look for ideas. Gold is one, precious metals. We'll try to find some other opportunities there. I'll sniff through, see if we can find some utility stocks, defensive things, niche things. But remember, cash is always an option. There's nothing wrong with having some or a good part, maybe even all of your money, your 401k funds. Every 401k plan that I've ever seen has a cash option. It's not going to be called cash. It'll be called stable value fund, money market fund, something along those lines. It's the right thing to do to panic out right now and put all there? No, probably not. I can't tell you what to do. I can't give individual investment advice, but it is something to consider because people are always wanting to know, where can I make money? They refuse. They don't want the money market fund because it doesn't pay anything. I say this. It's better to not lose money. If you can tuck into a money market fund, stable value fund during the next bear market, whether it's upon us now or it's 6 months or 6 years away, and the market drops 50% or more, like the last couple bear markets do, or even 30-40%, you might not make much or anything at all, but it's better than not losing. You have to take that mindset. There are times, and I think this is one of them, where there's very few opportunities because of everything that's gone on since the financial crisis and even leading up to that. There's just it's long-term stuff that's actually built for decades now, and this is part of it right here. TYX. This is a 30-year Treasury bond yield right here. So if you're not familiar, we've been in a secular bear market in interest rates. Rates peaked back here. Remember Ronald Reagan? Rates have been falling since the early 80s steadily, and we're near zero right now. Don't look at these numbers here. It's the 10-year Treasury bond. Rates have plummeted. There's really not much more downside to go. That means you're getting paid squat on bonds, and there's nowhere over time but for these to go but up. At some point, we can stay down at the bottom for a long time, but when rates finally start to go up, the price of bonds are going to go down. In other words, the incremental yields, once rates start to rise in your bond fund, in your 401k, or whatever you're buying, or an ETF, you will lose. This I can guarantee you. If rates do this, you're going to lose more in principal holding a bond fund than you will make in incremental rate increases as interest rates rise, because of bonds, the price of bonds, and the interest rates are inversely correlated. That is one certainty. Rates go up, price of bonds go down, and vice versa. So it's kind of like a catch-22 scenario is what I'm saying. There's just it's almost a no-win situation there. And again, I blame the Fed, blame what you want, but it's it's just what's happened over the years. This cyclical trend. Rates were well into the double digits back there. But that's that. Let's get off and wrap it up here. Another long video, but important times. So I'll try to keep my thoughts going to everyone, and if anything changes, and that's the one thing with fast-moving markets, the technicals can change on a dime. But as of now, I think the risk-reward, based on everything that's going on, favors either being out of the market, mostly on longs, or being short, like we are with the QQQ short trade. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.